The GameStop stock controversy is probably the craziest thing that I personally have ever seen in the stock market. Just 1 month ago, the stock was valued at roughly $18 per share. Incredibly, the cost per share rose to $469 at its peak and has settled for around $310 today. However, the case of GameStop is so much more than a bunch of amateur investors on Reddit throwing their entire life savings into a failing company. The decision to artificially boost the value of GameStop stock was meant to send a message to institutional investors that had massively overshorted the company and have taken advantage of so many people in the past. Today, I'm going to be going over this battle between Wall Street and the retail investor, how trading apps such as Robinhood have faced severe backlash for restricting the purchasing of GameStop stock, and the pathetic cries for regulation from hedge fund managers and elites that have gotten absolutely destroyed as a result. But first, feel free to subscribe to my channel if you haven't already to join the Millipreneur community, and leave a like on this video as well so it can be shown to other people outside of my community. Thanks so much. If it doesn't make sense to you why a failing brick-and-mortar game store has risen over 1,700% in the past month, it's because it doesn't make any sense. At least from a business valuation perspective. This store would literally pay you $10 of in-store credit if you dropped off your entire collection of old PS4 games. Not only that, but there has been a shift from purchasing games in person to instead simply buying them through your console from the comfort of your home. Thus, it is no wonder that the stock has been losing value for years and was only accelerated by the pandemic. Institutional investors saw GameStop's downfall as an opportunity to make a ton of money by shorting the stock. When you short a stock, you are essentially betting that it will fall in price. In other words, as GameStop's stock continued to lose value, hedge funds such as Melvin Capital were cashing in on massive profits. To be more specific, let's say that a hedge fund decided to borrow GameStop shares from lenders at a $1 fee and promises to give them all back with interest. The hedge fund would then sell the stocks at their current price. In this example, let's say that the value of the stock is roughly $10. Let's also assume that the stock indeed loses value and sinks to $5 per share. The firm would now repurchase the stock at $5, return it to the lender, and pay them $1 in interest. In this case, the hedge fund has made a profit of $4 per share. This strategy was making Wall Street investors billions of dollars, not only on GameStop, but also on other retail companies such as AMC and Bed Bath & Beyond. However, this can be an extremely risky investment if the stock happens to go up. In the case of GameStop, that's exactly what happened. This led to GameStop's stock being the most heavily shorted on the market, so much so that these investors on Wall Street had purchased more than they could have paid back. According to Business Insider, 72 million GameStop shares, which is roughly 140% of all available shares, were shorted as of January 22nd. In other words, there were more shares being lent than actually existed, and this is where Wall Street Bets comes in. Wall Street Bets is essentially a community of now over 6 million quote-unquote degenerates on the popular discussions website Reddit. If you were to go on Wall Street Bets forum, you'll likely see bold predictions from momentum traders, technical stock analysis, and a whole lot of memes. Generally speaking, I'd probably advise against using Wall Street Bets as a driving factor in your decision to purchase stock of any company, seeing that the typical trades on this site are quite risky, but I'm also not a gambling man. Moving along, the story really begins with a Wall Street Bets member referred to as deep value. This particular individual believed that GameStop was undervalued and invested roughly $50,000 into GameStop call options in September of 2019.
Just people could start piling on, and then you get the short interest too. I didn't want to go into. Hopefully, it's clear the short interest isn't a main point to this thesis, but you need to acknowledge it. It's out there. Could it be unwound in a systematic manner so that nothing happens? Yeah, probably. But I don't know enough about the mechanics of the market to be sure about that type of thing. I'm not betting on a short squeeze, but it seems like something where it could take place. Although I think if you wanted a real short squeeze, you'd probably want a more levered company where people were truly like it was on the verge of bankruptcy, and then suddenly it's not. GameStop, I don't know. We just got to see what happens, but it would be nice if it goes up really quickly. But when you see all this stuff kind of adding up, you need to at least consider it, take it into consideration.
At that point, most of his counterparts on the forum thought he was insane, which I probably would have agreed with. However, just a few months later, GameStop got some good news. First off, Michael Burry, the legendary investor that correctly predicted the 2008 financial meltdown, shared his optimism about the failing company and claimed that discs would actually keep the company afloat. In other words, since Sony and Microsoft were going to be launching their next generation consoles with disc drives, this meant that there would still be demand for in-store game purchases. Not only that, but every time a new console was released, GameStop stock has reacted positively. Now back to Wall Street bets and deep value. This maniac continued to buy call options of GameStop in 2020 despite stores closing down and terrible earnings reports. At the worst point of this risky investment, DFV was down $34,000. However, in late 2020, things began to get interesting. Ryan Cohen, billionaire investor and founder of the e-commerce pet food company Chewy, decided to become involved with GameStop and bought 13% of the company's shares. His goal was to elevate the company to compete with e-commerce giant Amazon. Cohen was then appointed to GameStop's board of directors along with Alan Attal, who was Chewy's CMO, and Jim Grube, who was Chewy's CFO. Since Cohen is a billionaire investor that has experience in e-commerce, the sentiment was that GameStop would also invest in its digital presence and change its business model. This is exactly what happened, as GameStop ended up signing a multi-year deal with Microsoft, which gave GameStop a percentage of Xbox's digital revenue and expanded both its physical and digital presence. This unsurprisingly increased digital sales as well as the value of GameStop's stock. Now fast forward to January of this year. This is when retail investors on Wall Street Bets noticed that GameStop stock was one of the most heavily shorted stocks on the market, since that information is actually publicly available. Thus, millions of members conspired against hedge funds to artificially skyrocket the value of the company. As the stock continued to increase at unprecedented rates, hedge funds were forced to buy the stock as well to prevent even bigger losses. This causes the price of GameStop to increase even more. This market phenomenon is known as a short squeeze. Firms such as Melvin Capital had no choice but to liquidate their positions and needed to be bailed out by other hedge funds to survive. Interestingly enough, many of these wealthy elites have actually decided to short GameStop even further because they are still confident that the stock will inevitably go down in price. They even had the audacity to get on live television and argue that this short squeeze was an example of market manipulation, which they literally do on a daily basis.
But there should be some restrictions on shorting. Maybe it's on the uptick. There needs to be a review by the national regulator on shorting in the marketplace. This is not a good time to be playing these games. The national regulator needs to get involved here and promptly.
The reason the market is doing what it's doing is people are sitting at home getting the checks from the government, okay? And this fair share is a bullshit concept. It's just a way of attacking wealthy people, and I think it's inappropriate. We all got to work together and pull together.
For example, back in March of 2020, billionaire investor Bill Ackman went on CNBC and gave a pretty crazy interview stating that hell is coming and that the hotel industry would go bust.
Hell is coming, okay? And I felt, it's really, I've never had this experience before in my life. The closest I had was the financial crisis where I'm saying, things are coming, bad stuff's coming. But this was a feeling like I've never had. Like there's a tsunami coming, right? The tsunami's coming in, you feel it in the air.
His interview sparked a panic selling of hotel stock. It is now seen as one of the leading motivators of that particular drop. Right after the interview, Ackman began to purchase literally billions of dollars worth of shorts and ended up pocketing $2 billion in profits against the market. So in essence, it's okay when institutional investors manipulate the markets, but if ordinary investors force hedge funds to lose billions of dollars, then that's not okay. Thankfully, this actually backfired on those greedy Elon Musk essentially egged on Wall Street Bets members by tweeting GameStonk on the evening of January 26th. This sent GameStop's price up to $230 from $150 and added additional momentum on the Wall Street Bets forum. At its peak, GameStop hit an astronomical $467 per share. Oh, and remember deep value? He ended up turning his $755,000 investment into over $48 million. This huge win for the average investor led to support from politicians, celebrities, and entrepreneurs alike. However, Robinhood was getting ready to spoil everyone's fun. Just a day later, on January 27th, the popular trading app decided to put restrictions on traders seeking to purchase shares of GameStop. Ironically, users were still able to sell their shares of the stock but were unable to purchase them. This caused GameStop stock to plummet down to $126 per share. Robinhood also restricted users from buying shares of BlackBerry, AMC, Bed Bath & Beyond, and other stocks that were experiencing incredible boosts in price. Robinhood claimed that ongoing volatility forced the company to take the necessary steps to limit such trades. According to Motherboard, more than half of the app's users owned one or more shares of GameStop, and they weren't the only company to restrict their users. Trading apps such as Webull and Stash also placed limitations on their traders. However, hedge funds still had full access to the stock, causing widespread criticism of Robinhood and any brokers that were likely in bed with Wall Street. This unprecedented restriction led to a class action lawsuit against Robinhood. In addition, the SEC has stated that it has noticed the volatility in the market and is taking a closer look. Once again, the focus is on the average investor that has had up until recently very little influence on the stock market. Today, Robinhood is allowing users to purchase GameStop in a limited capacity. How's that for market manipulation? As GameStop's stock has continued to rise, hedge funds' short positions continue to be squeezed and some companies have been forced to liquidate their positions. However, there are still roughly 62 million short positions active, which means that there are still plenty of better positioned short sellers that are betting against GameStop. Now, eventually, as the GameStop craze diminishes and the momentum starts to slow, investors will likely begin to realize their gains, causing the stock to come back down to earth. This is unfortunately where many people that got in too late will be left eating the losses. As I mentioned earlier, this monumental achievement for the average investor is not only to profit from Wall Street greed, it is also meant to send a message. Wall Street Bets members and many others who joined did it to be part of a fundamental shift in power from wealthy elites on Wall Street to the jobless millennials and Gen Z sitting at home. What do you guys think? Should Robinhood be punished or should Wall Street Bets be regulated? Feel free to comment below. And also feel free to subscribe to my channel if I provided you any value and leave a like on this video so it can be shared with others outside of my community. Thanks so much. Looking forward to seeing you on the next video.